Here is a summary of the Goldman Sachs Q1 2026 earnings call transcript, designed for clear and concise delivery. Good morning, everyone. I'm here to provide a detailed summary of Goldman Sachs' first quarter 2026 earnings call. Financial highlights and performance. Goldman Sachs delivered a very strong performance in the first quarter of 2026. Net revenues reached a robust $17.2 billion. Net earnings stood at $5.6 billion. Earnings per share, EPS, was $17.55. Notably, both net revenues and EPS were the second highest in the company's history. Return on equity, ROE, achieved 19.8%. Return on tangible equity, ROTE, was 21.3%. These results reflect the strength and diversification of Goldman Sachs' global franchise, its client relationships, and its ability to execute effectively, even within a dynamic market environment. Key segment performance. Global Banking and Markets. This segment was a standout performer, generating record quarterly revenues of $12.7 billion and an ROE exceeding 22%. Advisory. Revenues surged 89% year-over-year to $1.5 billion, driven by higher completed volumes. Goldman Sachs maintained its position as the one global M&A advisor. Underwriting. Equity underwriting revenues were up 45% to $535 million, while debt underwriting revenues rose 8% to $811 million, reflecting strong activity in investment-grade and asset-backed deals. FICC. Net revenues were $4 billion. While rates and mortgages saw lower revenues due to a challenging market-making environment, this was partially offset by significantly better performance in currencies and commodities, demonstrating the benefits of diversification. FICC financing revenues contributed $1.1 billion. Equities delivered record net revenues of $5.3 billion. Equities intermediation revenues rose 7% to $2.7 billion, and equities financing revenues reached a record $2.6 billion, up 59% year-over-year, with particular strength noted in Asia. The combined FICC and equities financing revenues grew 36% to $3.7 billion. Asset and Wealth Management generated $4.1 billion in revenues. Management and other fees were up 14% to $3.1 billion, largely due to higher average assets under supervision. Long-term fee-based net inflows were strong at $62 billion, marking the 33rd consecutive quarter of positive inflows. Total assets under supervision, AUS, reached a record $3.7 trillion. The acquisition of Innovator, which closed in the second quarter, is expected to add $31 billion in AUS, positioning Goldman Sachs among the top 10 global active ETF providers. Alternatives fundraising was robust, with $26 billion raised across asset classes, including $10 billion in private credit strategies. Platform Solutions reported revenues of $411 million, down year-over-year due to the transfer of the Apple portfolio. Future revenues are expected to align with seasonal trends. Financial Management and Outlook. Expenses. Total operating expenses were $10.4 billion, resulting in an efficiency ratio of 60.5%. The compensation ratio, net of provisions, was 32%. Non-compensation expenses, at $5 billion, saw an increase driven primarily by higher transaction-based expenses tied to strong activity levels, particularly in equities. Investments. Goldman Sachs is accelerating investments in cloud migration and data infrastructure to support AI solutions, aiming for future productivity and efficiency gains. Capital. The Common Equity Tier 1, CET1, ratio stood at 12.5%, providing a 110 basis point cushion above the current capital requirement. The firm actively deployed capital to support client activities, including prime brokerage and acquisition financing, and returned $6.4 billion to shareholders through share repurchases and dividends. Outlook: management anticipates a more constructive backdrop for the full year, citing fiscal stimulus, AI-related investment, and a more balanced regulatory agenda. However, they acknowledge ongoing geopolitical complexities and the impact of higher energy prices. Tax rate: the effective tax rate for the quarter was 13.2%, benefiting from stock-based compensation. The full-year expected tax rate is approximately 20%. Management statements: David Solomon, Chairman and CEO. Performance: described the quarter's performance as very strong, highlighting record revenues in global banking and markets and strong client engagement across the franchise, especially in FICC and equities, driven by client portfolio repositioning amid elevated uncertainty. Client focus: emphasized Goldman Sachs' role as a trusted advisor, providing differentiated insights and executing for clients in a rapidly evolving environment. He noted elevated engagement with digital channels like Marquee. Diversification: stressed the importance of their scaled, diversified, and global franchise in navigating varied market conditions and the need for deep expertise and risk discipline. Investment banking pipeline: stated that the M&A pipeline remains incredibly robust, with CEOs focused on strategic transactions driven by technological change and industry disruption. While IPO activity slowed in March, he expects it to accelerate if equity markets remain resilient. Private credit: addressed concerns by distinguishing between broad private credit markets and direct lending, noting the strength of institutional investor demand for Goldman Sachs' expertise and a 30-year track record characterized by rigorous underwriting and disciplined portfolio construction. He expressed confidence in their ability to deliver attractive risk-adjusted returns. Regulatory environment: expressed encouragement regarding the direction of regulatory reform, including the Basel III finalization and GSIB surcharge reproposals, viewing them as more balanced and risk-sensitive. One Goldman Sachs 3.0 highlighted ongoing investments in technology, including AI, and expressed confidence that this initiative will drive stronger operating leverage, resilience, and improved efficiency. Dennis Coleman, Chief Financial Officer. Financial details: walk through the detailed financial results, confirming the record revenues in global banking and markets, and the strong fee-based inflows in asset and wealth management. Balance sheet strategy: explain the deployment of capital into the client franchise, particularly in equities financing in Asia, as a strategic priority. He noted the significant deposit-raising activity as a strategic funding source, benefiting from digital platforms. FICC financing losses: stated that life-to-date realized losses in FICC financing activities, excluding direct commercial real estate, are zero, attributing this to rigorous underwriting, stress testing, collateral protection, and margining capabilities. Provision for credit losses: PCL clarified that the increase in PCL was due to growth in lending activities, single-name impairments, and adjustments for the overall operating environment, and not specifically related to private credit or FICC financing defaults. Efficiency ratio: reaffirmed the laser focus on driving towards a 60% efficiency ratio, acknowledging higher non-compensation expenses this quarter due to transaction-based costs linked to record activity, but emphasizing continued investment for longer-term efficiencies. Capital and regulatory proposals: confirmed that the firm is following regulatory proposals closely and finds the direction encouraging, with specific focus areas including the elimination of double counting and GSIB surcharge recalibration. The CET1 ratio of 12.5% is considered an appropriate level, providing flexibility for client activity and capital returns. Key risk factors and lowlights. Macroeconomic uncertainty. Volatility increased due to concerns around AI-driven disruption, heightened uncertainty in parts of private credit, and the conflict in the Middle East. These factors are weighing on client sentiment. Geopolitical landscape remains complex and could impact inflation and growth. Energy prices. The ultimate impact of higher energy prices on inflation and growth is still to be determined. Private credit sentiment. While Goldman Sachs sees opportunity, the media has contributed to negative sentiment around the private credit sector. IPO execution. Market conditions have tempered the execution of IPOs and sponsor activity broadly. Platform solutions revenue. Expected to run lower for the rest of the year in line with seasonal trends. Net interest margin, NIM, compression, impacted private banking and lending revenues due to deposit growth in a competitive rate environment. Regulatory uncertainty. While encouraged by the direction of reform, the rulemaking process is still underway, and the firm will participate in the comment period. Forward-looking statements and forecasts. Overall constructive backdrop. Management believes the potential for a more constructive backdrop this year due to fiscal stimulus, AI investments, and a balanced regulatory agenda. M&A activity. Expected to remain robust unless the overall environment deteriorates significantly. IPO activity. Anticipated to accelerate if equity markets maintain resilience. Asset and wealth management. Expects high double-digit growth in private banking and lending segment from 2027 onwards, with aggregate durable revenues in asset and wealth management expected to improve towards the end of the year and into 2027. Alternatives fundraising, on track for annual expectations, with continued focus on growing institutional business. In summary, Goldman Sachs delivered a very strong first quarter of 2026, characterized by record revenues in key segments and solid financial performance. While navigating a dynamic and complex global environment, the firm emphasized its diversified franchise, client relationships, and disciplined risk management as key strengths for future success.